If you are interested in buying a triple net lease property, either now or in the future, this video is for you. I am going to share with you the most comprehensive triple net lease investing guide for beginners. I will tell you everything that you need to know about triple net lease investing in 2026. And stay with me until the end because I'm going to give you a bonus tip. What are the best triple net properties to buy in 2026? If you are going to remember one thing about this video, remember this. A single tenant triple net lease investment property is the best passive income alternative for triple net investors beginners and 1031 exchange investors as well. A triple net lease structure is the purest form of passive income real estate investing in the market. The tenant is responsible for pretty much everything, from property taxes, property and liability insurance, maintenance costs, and capital improvements. No more clogged toilets or roof leaks calls. The tenant is responsible for all of that. And more important than anything, your passive rental income is net. Hi, my name is Alex Casablanca. We are a boutique brokerage firm based in Orlando, Florida, specializing in selling triple net investment properties. We represent triple net buyers and 1031 exchange investors as well in finding and negotiating the best triple net property according to their investment goals and risk tolerance. To make your watching experience better, this video is organized into 13 core topics. If you want to jump to a specific topic right away, you can access them throughout the chapters that are in the description below. First and foremost, what is a triple net lease? In simple terms, a triple net lease is a specific lease structure in which the tenant, in addition to the base rent, is responsible for the payment of property taxes, property and liability insurance, and common area maintenance costs. And that's where the concept of triple N comes from. Your passive income is net out of the three core expenses that the owner is usually responsible for. Beyond the traditional triple net lease concept, most single tenant triple net leases nowadays are structured as absolute triple net, which means that the tenant is also responsible for the building structure, parking lot, and capital improvements in general. That's what is called absolute triple net lease. And now, what is the main advantage of buying a triple net lease property? There are two major advantages of investing in a triple net lease property. First, a triple net lease investment property is a truly passive income investment. You buy the property and the tenant takes care of pretty much everything concerning the property, from property taxes, property and liability insurance, maintenance costs, capital improvements, among others. You receive your monthly rent either by mail or nowadays by electronic transfer, and you don't have to do anything else. The second advantage for a triple net buyer is that you are basically insulated from raising costs. In a normal rental property, if the city raises your property taxes or the insurance company raises your premiums, the money comes right out of your pocket. With a triple net lease, the tenant is responsible for all of those cost increases. And then, who are the buyers of those triple net properties? The typical triple net buyer is a passive income investor. Someone that is looking to receive a monthly rent payment without active involvement in the management of the property. In recent years, I have seen many multifamily and retail multi-tenant investors transitioning into triple net properties. These investors are often tired of dealing with all the hassles of managing a residential or commercial property, such as a constant tenant turnover or daily property maintenance. I have also seen many retiring investors who are consolidating their investment portfolios into long-term, stable, passive income cash flow with no landlord responsibilities, allowing them to enjoy their retirement without being on call for property emergencies. And what type of properties are those with triple net leases? A triple net lease property could be either a single tenant, such as a McDonald's, Walgreens, 7-Eleven, Dollar General, among others. Or it can also be a multi-tenant building with 4 or 5 tenants, or even a medical or industrial building. Technically, any commercial real estate investment property in which the tenant is responsible for paying the property taxes, property insurance, and maintenance costs is a triple net lease. However, not all triple net leases are created equal. The most popular type of property is the single tenant triple net lease, in which you only have to deal with one tenant, and that tenant pays for every cost concerning the property. The only thing that you have to do is to collect the monthly rent payment at the beginning of the month. It is the purest form of passive income structure. In other asset classes, such as retail multi-tenant, office, warehouse, or industrial properties, the tenant still either pays or reimburses the landlord for property taxes, property insurance, and common area maintenance costs. But the landlord retains responsibility for the roof, structure, and capital improvements. One important aspect to highlight is that there are multiple variations within the triple net lease structures in which the landlord involvement could vary. Every lease is structured in its own unique way according to the particular negotiations between the landlord and the tenant at the time that the lease was signed. So it is very important that you and your attorney review the lease carefully so you can have a clear understanding about the possible landlord responsibilities. And now, what are the typical lease terms of those triple net leases? To complement the passive income structure, leases are typically structured for long terms, ranging from 10, 15 to 20 years. And they also include rental increases either annually or every 5 years, which offers a hedge for inflation as well. Most leases also come with automatic renewal options of 5 additional years each time. So if at the end of the lease, the tenant might want to stay, they can continue extending the lease automatically every 5 years for certain specific periods. And now, who are the tenants behind those triple net leases? The backbone of the triple net markets basically consists of investment grade tenants, well-known names such as McDonald's, Walgreens, CVS, 7-Eleven, Dollar Generals, among others. These are large corporations that offer the highest level of security because the lease is backed by a financially strong company with a proven track record and a successful business model. Consequently, these properties will come at a lower cap rate because the risk of the investment is lower. Alternatively, a significant portion of the triple net landscape is fueled by independent franchisees. Most fast food restaurants such as Wendy's, Dunkin' Donuts, Taco Bell, among others, are owned and operated by independent franchisees. So the lease guarantor is not the global corporation, it's the independent franchisee. And not all franchisees are created equal. There are multi-unit franchisee operators managing hundreds of locations to smaller local entrepreneurs. So the due diligence is a little bit more challenging because you have to dig in companies that are private and you don't have that much information. While franchisee-backed leases generally offer a higher cap rate due to increased risk profile, the lease structure remains identical. The tenant assumes full responsibility for property taxes, property and liability insurance, and all maintenance costs, protecting the landlord from the rising expenses of property ownership. And now, what is the return or the cap rate that I can expect from those triple net leases? Like any other type of investment, the cap rate is in direct correlation to the level of risk involved in a particular transaction. The basic concept of investment that the higher the yield, the higher the risk, and the lower the yield, the lower the risk, That also applies to triple net properties. The better the area, the stronger the tenant, and the longer the lease, the lower the cap rate will be. Triple net lease properties located in top retail market, in strategic locations, with strong demographics, with a strong credit rated tenant guaranteeing the lease, such as McDonald's or Chipotle, are going to come up at a lower cap rate because the risk is lower. For those type of low risk investment, the cap rates could range from the mid 4% to the low 5%. On the contrary, tenants in which the perceived risk is higher, like Dollar Generals, Walgreens nowadays, CVS, cannabis facilities, small franchisee operators, among others, the cap rate of those are going to be higher because the implied risk is higher. Also, properties in which there are less than 5 years remaining on the lease, the cap rates are going to be higher because the implied risk is also higher. Properties within that high risk profile could range from the 6% cap to even 9 or 10% cap in some cases. With respect to cap rates, the key concept is simple. The higher the cap rate, the higher the risk. And the lower the cap rate, the lower the risk. Every investor has a different level of risk tolerance. Some investors are conservative investors and are willing to accept a lower cap rate in exchange of a property with a lower risk. And there are other investors that are risk takers and they don't mind assuming a higher level of risk in exchange for a higher cap rate. As an investor, you have to determine your risk tolerance and then set your cap rate expectations according to the level of risk that you are willing to assume. Does that make sense, right? And now it comes the great advantages that triple net properties offer to 1031 exchange investors. A single tenant triple net lease property is the absolute best alternative as a replacement property for your 1031 exchange. I have no doubt about that. It offers for your 1031 exchange the purest form of passive income because the tenant, as I mentioned before, is responsible for pretty much every major expense concerning the property. That will allow you to transition from a heavily involved hands-on landlord to a truly passive income investor. Instead of managing the day-to-day operations of a rental property, you simply receive your rental payment on the mail or through electronic transfer, making it for you the ultimate exit strategy. So that will allow you to step back from active management of the property and become a truly passive income investor. One of the biggest challenges in a 1031 exchange transaction is the strict IRS deadlines, both for identifying and closing on a new replacement property. However, the acquisition and due diligence process for a triple net property is significantly simpler than it is for an apartment building or a multi-tenant retail center. The core of your research during the due diligence process is the lease agreement. The lease agreement is the most important part of the due diligence process. Since the tenant is responsible for the building, capital improvements, and all operating costs, you can often avoid the lengthy and expensive property inspections that typically delay a closing. The simplicity of a triple net transaction make it so much easier to meet those tight IRS guidelines. Certainly, the number one concern for 1031 exchange investors is not being able to identify and close on a replacement property within the deadlines that the IRS imposes, and then being hit with a massive capital gain tax bill. Fortunately, the inventory for triple net properties is consistently ample. Whether you are looking for a specific brand name or a certain price point, there are usually plenty of alternatives available to ensure you will find a good replacement property according to your investment goals. Finally, if you have owned your current property for more than 10 years or even more, you have likely depreciated that property substantially, and that certainly lowers your cost basis. Selling without a 1031 exchange would trigger a huge capital gain tax bill, wiping away a significant portion of your equity. By rolling that equity into a triple net property, you defer those taxes and keep 100% of your money working for you. And now, a very important part. What are the risks of buying a triple net property? And more importantly, how do we mitigate them? Although buying a triple net property offers singular benefits to investors and can be considered a passive and low risk investment, they are not exempt from major risks that must be identified and, more importantly, determining if those risks can be mitigated in any way. For the purpose of this beginner's guide, let's review the top 2 major risks or concerns that I receive from my clients. Number 1, the risk of vacancy or non-renewal. The biggest question that I get from my clients: what happens if the tenant leaves or not renew the lease? Well, there are several alternatives if that situation happens. The first alternative is finding another tenant that can occupy the property. And that's when real estate fundamentals comes into play. Before buying a triple net property, you have to make sure that the property is located in a prime location with strong demographics, high population growth, high average daily traffic, and preferably in an area that is in an expansion. If the property is in a strategic location with strong real estate fundamentals, number 1, that will increase the possibility of the tenant being successful in that location. Therefore, they will want to stay there for the long term. In addition, if you might need to bring another tenant, the probability of replacing the original rent is certainly higher when the property is located in a top location with strong real estate fundamentals. The second major risk of buying a triple net property is the risk that the tenant might go bankrupt or will be forced to close operations and stop paying rent at all. A recent example of that situation is Red Lobster. Red Lobsters, although a well-known brand name and beloved by the majority of their customers, they were heavily indebted and they didn't have any other choice but to go bankrupt. As a result, they were forced to close a significant numbers of their locations. Certainly, that is a risk that is totally out of your control. And a tenant that is financially strong now when you purchase the property cannot be 5 or 10 years from now. So that is totally out of your control. But what can we do to mitigate that risk in some sort of way? First, do an extensive research on the tenants and brand name performance. If it is a corporate lease from a publicly traded company, such as Walgreens, Chipotle, Dollar Generals, McDonald's, among others, there is an extensive public information about the financial stability of that particular company. If it is a franchisee, it's a little bit tricky because those are private companies and the information that they provide cannot be verified. But you can still inquire about how many locations they have, look for recent news about the company, request the tenant financials if they are available, and even visit the property to see how they maintain the location. It is important to highlight that there are obviously other risks involved in buying a triple net property not mentioned in this beginner's guide video. So it is very important that you do your own research and your own due diligence. However, if you want to know more about other risks involving buying a triple net property, you can watch this video here that provides a more comprehensive analysis of the risks involved. Okay, Alex, and now, what are the best triple net lease properties to buy? This is the most common question that I receive from triple net buyers and 1031 exchange investors. The answer is simpler than you might think. The best triple net property is the one in which the tenant provides an essential and irreplaceable product or service to the consumer. As we all know, technology has created drastic changes in consumer spending and behavior. Nowadays, we can buy pretty much anything on Amazon. So it is very important to focus our search on brands that can be considered Amazon proof. Think about the necessities we have as a society and as humans. The top necessities that we have are food, shelter, medical care, transportation, among others. These are things that you cannot buy in Amazon, neither now nor in the foreseeable future. Here are the top 5 categories that provides those essential services. Number 1, fast foods and coffee shops. Fast foods and coffee shops are the preferred segment for most triple net investors. Within the context of food as a primary necessity, fast food restaurants provide that necessity quickly with maximum convenience and efficiency. Coffee, although not a primary necessity, most of us cannot live without a cup of coffee in the morning. Nowadays, you can order your food or coffee from your phone and you can get it even delivered to your door. During the COVID-19 pandemic, most fast food restaurants remain open and continue operating throughout the drive-thru, and they continue also making the monthly payments without disruptions. Top alternative on that fast food and coffee segment are McDonald's, Chick-fil-A, Chipotle, Taco Bell, Wendy's, Starbucks, Dutch Bros, Dunkin' Donuts, among others. Number 2, medical and healthcare facilities. With the current medical advances and new medications, people are living longer, increasing the need for medical care. Particularly, urgent and primary care facilities are in the first line of necessity and accessibility for the consumer when they have an immediate medical need. Dialysis centers are in the second layer of medical necessities, but are also an excellent investment alternative. There are several well-known and established care companies such as Davita, Fresenius, Medical Express, WellNow, Fast Pace, Urgent Care, among many others. The number 3 best triple net properties to buy: drugstores and pharmacies. Pharmacies are also in the first layer of necessity. Since the pandemic, they have transitioned into providing more primary care services like vaccinations and lab tests, among others. Even as they experiment with smaller footprints to deliver prescription faster, the physical location remains vital. Key tenants on that segment are Walgreens and CVS. Both are investment-grade tenants with solid reputations. However, you have to analyze each property carefully because both Walgreens and CVS are transitioning into smaller buildings, and some old properties might not be worth of your investment. The number 4 best triple net properties to buy: gas stations and convenience stores. Gas is a primary necessity that you will never be able to buy in Amazon. Most large gas stations, such as 7-Eleven and Wawa, they are installing charging stations on their locations. The top alternative for that gas and transportation segment are 7-Eleven, Wawa, Circle K, and Racetrack, among a couple of others. The number 5 best properties to buy: dollar stores. Dollar stores are also in the first layer of necessity for the consumer. They continued operating successfully during the pandemic, even with the global supply chain complications. Nowadays, dollar stores are transitioning into grocery market concept, in which they also sell grocery and products of primary necessity, such as milk, fruits, vegetables, chicken, and seafood. The top 2 dollar stores are Dollar General and Dollar Tree. Both of them are investment-grade tenants and Fortune 500 companies with a strong business model and a solid track record. The top alternative, as I mentioned before, to buy a triple net property in the dollar store segment are Dollar General and Dollar Tree. In summary, the top 5 best triple net properties to buy for your 1031 exchange are: number 1, fast food and coffee shops; number 2, medical and primary care facilities; number 3, pharmacies and drugstores. Number 4, gas stations and convenience stores. And number 5, dollar stores. The key concept is choosing a tenant that provides an essential and irreplaceable product or service to the consumer. And now, and very important, what are the best states or the best locations to buy a triple net property? That's a very common question from investors. And most investors start by looking for properties that are in their local state or close to where they live. But bear with me on this first. The best triple net property is not the one closer to where you live. The best triple net property is the one with the best location, the strongest tenant, the best demographic, and the best real estate fundamentals in general. Beyond that broad concept, I'm going to give you some guidelines. First, most investors prefer to invest in triple net properties that are located in the so-called tax-free states, in which the passive income is not subject to state income taxes. There are 7 tax-free states that offer a variation of a no-income tax state. Both the state of Florida and Texas are the preferred states to invest among triple net investors, as they both have a strong economy, strong population growth, and a business-friendly environment. However, it's important to focus on growth markets in general. While tax-free states are great, you really can find a great triple net property in almost any state, as long as you make sure that the real estate fundamentals are strong. Important aspects to look for are high traffic corners, near major highway exits, proximity to anchor tenants like Walmart, Target, or Home Depot, strong population growth, areas where people are moving to, not moving from. If you live in a high tax state like California or New York, investing in a tax-free state like Florida is one of the most effective ways to protect your investment from high state income taxes. And now, another common question that I receive from my clients: and what are the financing options to be able to finance those triple net lease properties? Yes, there are many financing options from national and local banks. There are also mortgage brokers that have access to multiple lenders nationwide. However, when buying a triple net property, financing should be used wisely and conservatively. And I'm going to explain you why. A triple net lease property is a passive income investment in which the tenant is responsible pretty much for everything. As a result of that fact, the cap rates of triple net lease properties are going to be lower than a traditional commercial real estate investment property. Therefore, if you buy a triple net property with a high leverage loan to value, like 80% mortgage and 20% down payment, the cap rate will simply not sustain a high leverage financing structure like that, especially in the current interest rate environment in which commercial mortgages are still in the 6% and above threshold. In a high leverage structure like that, the cash flow numbers are not going to add up. The majority of the rental income will go towards paying the mortgage, and the transaction will not make any sense to you. If you are considering buying a triple net property with financing, you should not leverage more than 50%. And even leveraging only 50%, you might still be in a position in which most of your rental income will go towards paying the mortgage, leaving you with not enough passive income cash flow. And now you might think, what are the next steps that I have to take to buy a triple net property, and how can I get access to those properties? Well, I'm going to explain you how. I'm going to give you 3 simple steps to start the right way. First, you are going to start by defining your risk tolerance and your investment strategy. You have to define yourself first as an investor. And what do I mean by that? Are you more of a conservative investor that wants to buy a property with the lowest risk possible? Or are you willing to take an additional level of risk in exchange for a higher return? Every investor has a different level of risk tolerance. Some investors are conservative, while others are risk takers. None of them are right or wrong. It all depends on your own particular situation and your risk tolerance. The goal is to define the level of risk that you are willing to assume, and then you set your cap rate expectations accordingly. Remember the key concept: the higher the cap rate, the higher the risk. And the lower the cap rate, the lower the risk. That will determine the next step. Then, the second step is to define your investment criteria. In other words, know exactly what you're looking for. And I'm gonna give you a simple example of that. Alex, I am looking for a fast food restaurant property in a price range between $2 million and $2.5 million, located in a tax-free state with a cap rate of 6% or higher, and with at least 10 years remaining on the lease. Having a clear picture of your investment criteria and what exactly are you looking for will be a determinant factor in the success of your transaction. And then the third steps. Once you have defined your risk tolerance and your investment criteria, the next step is important. You must hire a knowledgeable and experienced triple net buyer's broker with access to national triple net listings. Your buyer's broker will be your strategic partner and will help you navigating the complexities of the market. If you call the seller's broker directly, their job is to get the highest price and the best terms for the seller, who is their client. So they are not going to highlight the negative details or potential hidden risk on that particular property. Your buyer's broker will be able to dissect those hidden risks on behalf of you, and that could create a great impact in the success of your investment. Your buyer's broker is like your attorney. By no means you will allow the seller's attorney to represent you, right? You're gonna hire your own attorney. Well, it's the same with your buyer's broker. In summary, buying a single tenant triple net lease property is the best real estate investment option for both triple net buyers and 1031 exchange investors that are looking for a replacement property. A triple net lease investment property is the purest form of passive income real estate investment. The tenant is responsible for property taxes, property and liability insurance, maintenance costs, and in most cases, capital improvements as well. So your rental income is net. Yes, net and without headaches. At Casablanca, we specialize in representing triple net lease buyers and 1031 exchange investors. We have the knowledge and expertise to guide you along the way. From market research, identifying potential properties, submitting offers and negotiating them, due diligence, up to the closing table. We have helped many triple net buyers and 1031 exchange investors in finding and negotiating the best triple net property according to their investment goals and risk tolerance. Moreover, we represent our buyers for free since we get paid from the seller, and we also pay for our buyers' closing costs up to a maximum of $10,000. This incentive will offset, or in some cases cover completely, the major buyer's closing cost expenses, such as title fees, attorney's fees, recording fees, among others. We are the brokers that give you more in exchange of your trust. If you have any questions or need guidance with your upcoming triple net lease property acquisition or your 1031 exchange replacement property, feel free to contact me directly and I will be in contact with you. Please also subscribe to our email list by scanning the QR code on the screen, and we will send you our weekly top 50 best triple net properties for sale nationwide USA. Well, you got all the way into the end of this video. Thank you very much for watching this video. And if you found it helpful, please give it a like and consider subscribing to the channel for more videos about triple net lease properties. If you want to know more about triple net lease investing, the video playlist next to this video provides a comprehensive guide of more than 25 videos on how to buy a triple net property. Thank you so much again for watching this video, and I'm looking forward to being your broker in your next triple net property acquisition. Have a great day.